we'll hit you with Reg A+. So earlier we were able to talk about the different financing options, 506, C and B. But what we're going to talk about now is really a new way to raise capital without the need of needing to become fully SEC reporting and to be able to have an established public market to go with these shares. So I'm going to really have the majority of this presentation run by this panel beside me because they give you a wide depth and breadth of the understanding of everything that needs to come together to make a Reg A Plus offering transaction happen and go public. So we have David Feldman. You've actually met all the panelists earlier, but just to reintroduce, in the light of Regulation A+, David Feldman has had extensive research or experience working with Regulation A+. In fact, he coined the term Reg A+ itself. So working very closely throughout the past years in terms of bringing it to life. We also have Kara Kennedy with ClearTrust, who will work us through the process and the actual share issuance to make sure everyone's comfortable with that role. How do these shares get created and how do they actually get into the hand of shareholders? And then what? How do you actually establish a public market for that? So we're going to have Jason Paltrowitz talking about the public market options. So with no further ado, I'll pass it off to David to get started to really introduce Reg A+.
If I can figure this out. Hey. Okay. Cool. All right. Hello. You're going to get sick of the three of us.
We've met before.
Hope you're properly caffeinated. So we're going to talk about existing Reg A, which was, well, now not existing, prior Reg A. I should probably change it. The Jobs Act, which changed or demanded that the SEC make changes in Reg A. The offering process and shareholder record keeping. We're not going to do that. They're going to do that. And then they're going to do establishing a secondary market. So let's talk about topics 1 and 2. And I do this. Groovy. Okay. So existing is probably not a good word because that's from pre-June. On June 19th, the SEC's new rules on Reg A became effective. Let's back up. Prior to that, there was the Jobs Act in 2012. Prior to that, there was old Reg A. We won't spend a lot of time on it because it doesn't apply anymore. But it was completely unpopular. There were maybe 5 or 10 Reg A deals done in a 5-year period. During the same time, there were something like 30,000 Reg D offerings. So if you get the difference. But the idea, at the time, it was limited to 5 million. You had to go through full blue sky review. And you were not an SEC reporting company afterwards. In addition, there was some ability to use resale up to 1.5 million. You were still filing on paper instead of electronically. It was limited to US and Canadian companies. And as I say, virtually nobody used it. So now let's talk about what matters. 2012, I worked with the Congressional Financial Services Committee to help write the language that said, SEC, we direct you to increase the amount that can be raised in a Reg A offering to 50 million. And when you do that, you can preempt state review of these offerings to the extent that you sell to qualified purchasers, which is a term that Congress said we're going to leave to the SEC to define, which has now become a problem, as we will get to. So they also said that the SEC can require audit and some reporting, but that's up to them. So now, in my view, brilliantly crafted set of rules, and I don't say this about the SEC probably ever, but I know the woman who wrote this, and there were 2 main rulemakings the SEC had to do under the Jobs Act. One was crowdfunding, which is the raising up to $1 million in a private offering, and the other was this. And if you read the proposal on crowdfunding, that's still not finalized, you pretty much read it and go, it seems like the SEC doesn't want anybody using this at all. But if you read the rules on Reg A+, it really seems like they're trying to encourage and attract people to use this. And the reason is a variety of things. They'd rather you come through the front door, frankly, than do a reverse merger and come through the back door. That's a big part of it. They've also, people have complained a lot about the difficulties and challenges of the traditional IPO market. And allowing a sort of simplified IPO, they thought was very attractive, so long as they could maintain appropriate investor protection. So what they designed was the following: a 2-tier system where tier 1 will be like old Reg A, which was the reason I kind of had to explain it. Up to 20 million, you can raise in an old Reg A, but you're still subject to full blue sky. You can be reporting or not. You don't have to audit if you don't want to, up to 20 million. Tier 2 is any amount. It can be under 20 million. Any amount up to 50 million if you opt into Tier 2. Tier 2 has more requirements, but lets you raise more money, and most importantly, gets you to be state blue sky preempted. One of the other big advantages of Reg A that's always been there is test the waters, that you can broadly check with potential investors before you file, and now under the new rules, even after you file. And so some of these brokerage firms that have big retail operations can literally make thousands of calls if they want. Under current rules with a traditional IPO, you can only do test the waters with sort of high-end institutional investors. With a Reg A deal, you can go as broad as you want, and a lot of the investment banks we're talking to think that that's a major plus. Filings will be able to be confidential, just like the S1. One little wrinkle, though, that makes it more interesting. If you do an S1, you have to come out of being confidential 21 days before your first roadshow. The Reg A rule says you have to come out of being confidential 21 days before the SEC approves your filing, which actually means you could do a roadshow while you're still in confidential filing, which you can't do with a traditional S1. And some of the banks think that could be attractive as well. As we say, the Tier 2 offerings are preempted. They are requiring audited financials in Tier 2, but Canadian companies can use IFRS. And unfortunately, as we'll see, they didn't change the geographic limitation, and you still have to be a US or Canadian company to use Reg A. I think indirectly that was a way of saying we'd rather not have Chinese companies doing this, frankly, but they couldn't say that. Interestingly, you don't have to be a PCAOB auditor. You just have to use PCAOB standards or generally accepted auditing standards. The clients I'm working with, they all are going to use PCAOB, but that is an option. I'm going fast. After you go public, you have different choices post-reporting. If you want to be a full reporting, SEC reporting company, then the narrative you use has to be basically like an S1. If you want to opt into what they're calling the light reporting system on Tier 2, or what I call the light reporting system, you can choose to do a lighter disclosure document, which excludes some of the more annoying things that really don't matter that much to most people. Like you don't have to do conflict minerals disclosure. You can do 1 year of executive compensation instead of 3. Things like that are just a little bit less throughout. And after you do that, you're not a full reporting company, but they've offered this opportunity to say, hey, you want to be public, but do some reporting and keep your compliance costs manageable. They do a twice-a-year reporting, so 6-month and 12-month. And there are some 8K type current report requirements. And then, other than that, that's it. The insiders don't have to report their ownership. You're not subject to the proxy or tender offer rules. And that's a choice that some companies that want to kind of get used to being public and not have significant costs might find attractive. The OTC QB, as we'll hear, has already approved quoting even the light reporting stocks on there, even though previously you had to be full reporting to be on QB, but we'll hear more about that. You can do a shelf offering for up to 2 years. Now here's the problem. Massachusetts and Montana filed a lawsuit to invalidate these rules. And that lawsuit is still pending. And we don't know what's going to happen. And so that is one of the reasons that there have not been a huge number of Reg A filings yet. Most people believe the lawsuit will be unsuccessful, but there are some technical arguments they're raising in how the rules were drafted that could possibly require the SEC to kind of rewrite the rules. It's not going to change the preemption of state blue sky review because that's in the statute. What they're saying is the SEC overstepped their authority under the statute in doing the rules. Okay, but once that's resolved, there are limitations for certain investors in Reg A Tier 2 offerings, and that is that if you're an unaccredited investor, you can't invest more than 10% of your income or net worth, and if you're not a person, you can't invest more than 10% of your net assets or annual revenue. We talked about reporting. The other stuff is not that critical. Okay, so people always ask, well, why would I do Reg A versus an S1? And we're going to do quickly an analysis of Reg A versus S1 onto over-the-counter, and then we're going to do Reg A versus S1 to a national exchange. If you're doing a regular over-the-counter IPO, there's no question that Reg A is significantly preferable, mainly because of the blue sky preemption, which you wouldn't have with an S1. Secondly, you can test the waters with any investor, not just institutional guys. You will have the option to have reduced offering disclosure and reduced reporting. This idea of staying confidential during your roadshow is attractive to some. And the belief is that the cost and review is all going to be quicker and cheaper. What most people don't realize is that any company raising up to $50 million and looking to go public should use Reg A, regardless of where they're planning to trade, in my opinion. Because there's no reason not to. You have the option to become a full reporting company, assuming you meet all the standards for the higher exchange. You would assume, although we don't know until somebody's presenting it to them, that the NASDAQ or MKT would not have an issue listing those companies. And so there are still advantages to using Reg A, even when you're going straight to NASDAQ or MKT. The broad test of waters is still there, the confidential filing during roadshows. And then another thing that an investment banker pointed out to me, he said, sometimes we're doing a NASDAQ IPO, and it's a smaller deal, and we may not raise as much as we thought we would. Or NASDAQ has some issue with the company and says, come back in a year. And normally we would just kill that deal and it would be over. But now what we can do, because if we downlisted it, we'd have to start blue sky and it would take forever, and that's why we killed the deal. Now, by having done the whole thing as a Reg A from the beginning, if we decide to downlist, we can get right through, no blue sky review, and you're trading over the counter. So that keeps that option open. And there's, again, no reason not to use Reg A unless one of the exchanges says we don't like coming directly to us with it, and nobody's said that yet. So I don't know if I'm over my 10 minutes, but that's my overview.
Thank you. So the SEC requires, if you do a Tier 2 offering, you have to hire a stock transfer agent, which begs the question, what is a stock transfer agent? Our primary role, to simplify it, is shareholder record keeping. So we issue the shares, we transfer the shares, we liaise with your investors, we keep you in compliance with federal and state regulations. Beyond that, if you end up paying cash dividends, we'll be the paying agent for those dividends. We'll do your IRS cost basis and tax reporting for you. And then, of course, with your shareholder meetings, would be the administrator for that as well. So when you think transfer agent, it's just anything that has to do with your shareholders and record keeping for your investors. That's what we're going to do for you. If you do a Reg A Plus offering, what is that actually going to look like? This is a common question. How do the shares get created and then ultimately deposited in a secondary market? You'll be happy to know that with ClearTrust, this process is streamlined, it's simple, and it's entirely paperless. So at your closing, you're going to use either our website or email to submit the order for the shares to us. We're going to authenticate that order and issue the shares in book entry to you, so to your shareholders. So all of your shareholders will receive a statement. It's going to be branded with your logo and your colors. It's going to show they have an investment in your company. It will show very well. They're also going to have online account access. It looks a lot like a brokerage account, and actually those electronic shares can eventually one day be deposited into their brokerage account. So this truly is a seamless, paperless, very simple process. With ClearTrust, we boast the fastest turnaround time in the industry, so you're looking at 24 hours standard or less. And then after the fact, and this is very important, and it's something that so few people, I think about, after the fact, all of those documents that were submitted to us pertaining to the issuance of these shares, the subsequent transfers of these shares, all of those documents are indexed and archived in PDF format. So literally 5 years from now, you can call me up and say, Kara, I'm going through this horrible audit and I need the last 5 years of issuances we ever did. And literally in 60 seconds, those documents will be consolidated and remitted to you securely. It's a fantastic system. It's something that's unique to ClearTrust, and it's one reason that I would say if you're a private company considering one day going public, you should always hire and have us join your team sooner rather than later, because the sooner we're going to start archiving all of your documents for you. So the process itself, though, in a Reg A Plus offering, it's going to be very, very simple. But, yes, you're going to hire a transfer agent because the SEC is requiring you to do it. But, I'd like to, I'm sure you're thinking, well, what actual value is it? What do you do, or what can you do other than just keep record of who our shareholders are? Issuers are hit from a surprising number of different angles with regulatory obligations. And I have never spoken with a single issuer, public or private, that's actually aware of all of their regulatory obligations. And scary thought, we audit incoming records from other transfer agents on incoming accounts, and 90% of those records are also not fully compliant with the regs. So, it's not just about you need to hire a transfer agent. You need to hire a really good transfer agent. Some of the things issuers are exposed to, for example, are unclaimed property. Every single state and territory, 54 in all, has their own unique set of laws that pertains to unclaimed property and escheatment. And so, and it's not that it's the transfer agent's obligation, it's your obligation as an issuer of securities to comply with 54 different and unique sets of unclaimed property laws. All right, if you don't have a transfer agent doing that for you, you're going to have to figure that out on your own. Then if you're going to, if you don't have an agent, you're going to have to deal with transfer of securities yourself. And that requires an in-depth knowledge of UCC Article 8. That's foreign. That's a foreign concept to most issuers. It's not something you want to meddle with on your own. You're also going to have to comply with IRS cost basis reporting, which is a nightmare since 2011 in and of itself. You're also going to be hit with Patriot Act compliance, particularly OFAC compliance, which is essentially a rule that says that we shouldn't be doing business with terrorists, but you have to make sure there's a process to make sure that you're not, right? So you're going to have to worry about that. And you're also indirectly going to be hit with FINRA 0905. Long story short, what that is it's a ruling that essentially makes it very expensive and very difficult for your investors to deposit stock into brokerage accounts when that day comes. And because of this reg, or it's not really a reg, but because of this letter from FINRA, shareholders are going to have a very difficult time locating brokers and depositing those shares. Well, you need a transfer agent that's going to be able to protect you from all of these different angles, that's going to be able to pour resources and be truly an ally in your team to be able to help you to comply with all of these things, to navigate these regulations, and to actually be successful. So that is the true value that you're going to see in Clear Trust, not just that we're going to make your Reg A Plus offering simple and streamlined and paperless, which we will, but we're actually going to be that long-term partner that makes a true difference for you and your investors down the road. And that actually segues perfectly into that's establishing the secondary market. So I'm going to hand it over.
All right. So if you're not afraid of going public yet,
You shouldn't be if you have a really good transfer
if
agent.
you have a really good transfer agent. So, we think where are we?
You're good.
There we go. Establishing a secondary public market. So you've chosen the route. We've talked about Reg A Plus and how advantageous it is. You can raise up to $50 million. You can raise it with retail investors. You get state preemption on the offering. One of the biggest things is those shares become immediately available for secondary trading. And because you're not, assuming you choose the route of not going directly to NASDAQ or NYSE, and we've been speaking with every Tier 2 company that's been filed, and because it's so new, they're choosing, doesn't look like they're going to go directly, it will be over time. The beauty of it is you now have a secondary market to trade your shares where historically you didn't, and OTC markets becomes that secondary market. And so this really becomes, in the earlier panel I was on, we talked about how you couldn't raise capital on OTC, right? And that was the advantage of New York and NASDAQ. The reality is you kind of can now raise capital on the OTC, so through this mini IPO. So you've got $50 million in capital that you can raise, up to $50 million. You now have shareholders, and you now have a public market where your shareholders can see real-time bid and ask, right? They can see the book, you're distributing information, and so it's the look and the feel and the taste of a public market that prior to this rule didn't exist. So while, yes, you do have the option of going to exchange directly, as David pointed out, it is a little onerous and cumbersome. Now you have that second option of being able to find yourself on one of the OTC markets. So as I said earlier, the market you need now. So I talked a little bit about this in the last panel, and it's something to consider when you are looking at what market to go on. And as most small companies are doing Reg A+, if you look at kind of the smaller you are down the line, and you look at pennies from so this really is showing you how trading works for small companies. And clearly the bottom line there, right? So the spreads are really tight when you're a really big company and when you're trading through a matching engine at New York or NASDAQ. When you're a small company, those spreads are really wide. And that's, again, what I said earlier, going back to who owns you when you're a small company, and how the process works for trading. So if you're only trading 100 or 200 times a week, a day, limit order matching engines become very complicated. So for a lot of those reasons, companies that are doing a Reg A+ and that are new to the public market, they're going to want to, again, grow into being public and looking at how to do that. So again, this is kind of, we've merged two panels that are very similar. So it really is the growing up, right? So the exchanges are graduating, but most of us have 21 to 22 years before we graduate college. So it is that process of growing up through the life cycle. So what does that mean? So OTC markets becomes the natural marketplace for Reg A+ offerings, and we have three markets. So our best market is OTCQX. That market has very high financial standards, similar to NASDAQ's financial standards. OTCQB, our venture market, no financial standards, but some verification and qualifications. And then Pink. Pink is an open marketplace. When you get a 211 filed, you automatically go to Pink. There's usually no company involvement on Pink, and Pink is where you'll find those old pink sheet kind of distressed dark companies. So to facilitate Reg A+, we've changed the rules for both QB and QX. For QB, we've just taken, now I should preface this by saying, to be on QB or QX, we're only accepting Tier 2 deals, so that higher level of Tier 2 Reg A+. We've amended our OTC QB rule set to basically take the Reg A+ Tier 2 standard. So anything you're doing for your Tier 2 Reg A+, that we will take and will allow you, once your 211 clears, to automatically apply, assuming you meet the criteria, and be on OTC QB. For OTC QX, we are allowing Reg A+, but with an added feature. And as David pointed out, Reg A+ only requires semi-annual and annual. But because of some issues that David can probably talk about with 144, Rule 144, we are going to require that companies actually also do a quarterly filing under using Form 1U, so that you will always be current in the 144 and that you've met that higher standard. So it is the opportunity to go to QX with a little bit more work, but to immediately go to QB as the rule is currently written. So things to consider. Am I big enough for QX? So to qualify for QX, we follow the SEC's penny stock rule. So you would need to, do you have that 10-cent minimum bid price? Would be one, and then the penny stock rule. Are you ready for that additional disclosures? Like I said, the quarterly disclosure under 1U. And it is a PCAOB audit requirement, for QX. So not that you're following PCAOB rules, but that you actually have a PCAOB auditor. For QX, we do have a requirement of minimum blue sky that we help facilitate. So while you are blue sky exempt for the offering, you are not blue sky exempt through Reg A+ for secondary trading. So one of the things to consider is, do you want to have that blue sky exemption for your secondary trading? For some companies, it's important. For others, it's not. If you think about who the investors are in a lot of these companies, it is self-directed investors. It is usually in the jurisdictions where you're doing business. It is usually with people where potentially blue sky for secondary market trading isn't as important, but certainly as you grow up through that process, it becomes much more important. For QX, also part of that additional quality is that we do require a third-party advisor to endorse you, so a sponsorship, kind of similar to the AIM model in the Nomad model and the AIM market in the UK. So that is an additional consideration if you're looking at QX. We've doubled up the slide. For QB, there's really not that much to look at, right? You're just using your Reg A plus standard, and we're accepting that as is.
All right, well,
So I
this
think
is
that
me
goes
now.
to
Thank
you.
you, team.
Yep.
So I hope you guys are excited. Hope it's not just the food that's making you guys quiet here, but what does this mean for you
Are you
guys?
still awake is the question.
You're able to raise up to $50 million now to unaccredited investors without needing to be fully SEC reporting. That gives you a lot of capital without a lot of cost, which we were talking about earlier as being that balance. And it's a really great space for these small and mid-sized companies to be trading and operating in now. It is new. Like we mentioned, it came out in June, so there'll be some first movers on it, and we're really excited to see where it goes moving forward. But what I wanted to do, because it is new, is give you this quick breakdown to really help you conceptualize how does this offering actually take place. I mean, it's not it's not going to be what you saw Facebook doing or Alibaba going up onto the exchanges. There's a lot more work that the company needs to be aware of to make sure all these pieces of the puzzle come together. So we had a great team here to give an overview of what all those pieces are and things to consider. But just to look at it here, David talked to the filing requirements and what you're working with the SEC. So instead of filing your Form S1, you'll be filing your Form 1A as opposed to a traditional IPO. And then you're going to be going through that test the waters phase, and you're going to be doing that up until the offering is qualified, and you're actually able to go out and give those shares to investors and get the cash, the capital in return. But at the same time, to be able to make that link from creating those shares that Kara had talked about, you also need to be having that link with the public market, so with OTC Markets Group. What does that itself require? Because we are an alternative trading system and we operate as a network of broker-dealers, you actually need a broker-dealer to sponsor you onto the public market to become tradable. That is done through the Form 211 process, and so there's this piece that you'll need to work with a broker-dealer to make sure that they are applying to FINRA to get your 211 cleared. That's the piece that gives you that 4-letter ticker. At the same time, as the company, what else do you need to be doing? Like we talked about, you need to be hiring your transfer agent. You also need to get your QSIP number, which is like an identification in the public markets. And then you also need to be giving that application to OTC Markets Group for us to qualify and verify QB or QX. As a marketplace, we will be working with you, making sure all these pieces come together. But we're also reviewing this application, doing that due diligence, make sure you do actually qualify, and make sure you're going to adhere to the Reg A plus filing requirements. So this all happens in conjunction with each other. So when the offering is qualified, when the 211 is cleared, and when your application is approved, we're going to enter that 4-letter ticker symbol into our marketplace, and then the company is now publicly traded. So we did leave some time for a lot of questions. I'll go right into it. But before I do that, I do want to point out that this is a process that we outlined for a private company going public. This can also be used as a secondary offering if you're not already fully SEC reporting as a company. So you could already be trading on the OTC markets with a ticker, have a public marketplace, and do this as a follow-on offering as well. Of course, you just won't be looking at that 211 piece. So we'll go ahead and do you.
It says offering is qualified. Does the Reg A plus go effective with the SEC, or is being qualified different than effective?
It's different because the Reg A is not a registered offering. It's technically an exemption from registration. So rather than the offering statement, as it's called, going effective, they say it's qualified. And so when they run out of comments, they will declare it qualified. But it's the same basic thing. Yeah. I mean, it's a 400-page release that put in this whole new system. So we've become experts in it, but not a lot of other people have. And so it's going to take a little time for everybody to absorb it, get used to it. It's literally a whole new system of, reporting and disclosure.
I do think on the back table we do have 2 process documents.
They're excellent. You should all grab them.
From like soup to nuts for both QX and QB, exactly what it's basically this, but much more detailed as a step-by-step for anybody that's interested in going through that process.
Yes.
Sure, we'll go ahead with,
Okay.
oh, great, we got a microphone for this one.
Yeah, do I need the microphone? Yeah. But my question is this, and it's really for the floor as much as anybody else. They're talking about being able to deposit these securities in this Reg A. Does anybody know anybody that actually deposits, broker dealers that actually take stock in on penny stocks?
Yes.
Yes.
I know
Besides
about 4
Core
or
and
5.
Alpine? Besides those two, does
It's a
anybody
problem.
know of anybody else?
It's a real problem.
It's a
Be-
real
Yeah,
problem.
that's
because
a
when
real
you're doing
problem.
these offerings and somebody says, "Oh, I want to just put it in my Ameritrade account,"
Yeah.
Like, well,
you can't. You
Right.
can't. And
Right.
so that's an issue we've got.
It is, and there was so much excitement about Reg A Plus that this was just going to revolutionize capital markets and Main Street meets Wall Street and all this hype around Reg A Plus. But the regulatory environment that we're operating in has not changed. So it is equally as difficult and expensive to deposit microcap securities into brokerage accounts, whether you do a Reg A Plus offering or not. Unfortunately.
But well,
No.
we're working
and the
on
rich
it.
get richer.
They're in the same state, though.
Yeah, they got each other's numbers.
We're getting there.
But these things do go away. I mean, a few years ago, the big issue was DTC.
Yep.
Right.
And we were having a major issue
That was
with DTC kind of saying we want to get out of the business of approving electronic trading for pretty much all small stocks. And the SEC actually stepped in and put the hammer down and said, no, you can't do that, and we're going to make people have a right to appeal and all of that. So that issue has mostly gone away, and I don't think anyone's anticipating any problem with DTC approving
Right.
these Reg A securities for
No,
electronic
this
trading.
goes in under the new issuance process at DTC. So
Correct.
assuming you do this as a new issuance under the DTC rules, it's kind of that fast track process.
So
if
we'll
you
get
go to
past the
problems.
deposit thing, too.
Yeah.
And the other thing is DTC has a dematerialization agenda, which means they're trying to get rid of paper stock certificates, which motivates them and incentivizes them to approve more and more companies for DWAC electronic deposits. So I would agree, this Reg A Plus just fits perfectly in with that.
Since I have the microphone, I guess I get the floor. To me, it appears that the elephant in the room is, in any transaction, there's a supply, the seller and the buyer. There's a supply and then there's the demand. Do you see anything changing at the FINRA/SEC and their predisposition against the liquidity drivers that are raising the cost of capital so much? I mean, all of these roundtables have been about complying with a whole lot of regulations that cost money and support legal firms and transfer agents and advisors and accountants. And nowhere do I see the SEC or FINRA addressing the absence of demand. And there are some really strangulating processes that are going on here, not being able to deposit stocks, brokers not taking stocks, penny stock rules being expanded beyond what they were meant to do. Other than, as a sub-NYSE MKT issuer, I can't find brokers that can talk about my stock, deposit my stock, or buy my stock. So to me, all these other points are moot. Yeah, you guys got a great exchange. I'm a member of the OTC QB, but that just helps for somebody to look up my price on the computer, but it doesn't trade because it can't trade because no brokers can buy it. They have no incentive to tell their clients to buy it. And it's something like the regulatory bodies in this country don't realize that the cost of capital for sub-NYSE MKT companies is several-fold higher than somebody that's up a tier. And is there any movement in your big groups, like like the OTC people, to lobby to rake back and claw back? I mean, yeah, the A plus is a wonderful piece of legislation, but like you said, it's 400 pages long. I mean, that's not better. It's just more.
It is better. It is better because IPOs became unmanageable, time-consuming, expensive, dilutive, and risky affairs that most people go away from unless you're a very, very far and mature company. But yet, there are many companies that could really benefit from being publicly held and having a publicly trading stock to raise capital, to make acquisitions, to grow, where venture capital dies, you know, in these biotech companies, et cetera, and they have no way to get there. And this offers an alternative for these companies to say, all right, there's another way to go. And I think that one by one, these things are being addressed. I think this is the SEC saying, we're going to draft something to encourage small companies to want to be public and do it the way we design. That said, you've got issues like the deposit of stock, et cetera. We've got our annual SEC Small Business Conference coming up, which is 4 or 5 years ago when I did coin the term Reg A+, where we sit around and make recommendations. And they do get looked at. And they do, Congress reacts to them, the SEC reacts to them. And this is something we're going to bring up this year, because we haven't in previous years. This issue of the SEC needs to tell FINRA, to tell the clearing firms, that they should leave the brokerage firms alone and stop telling them not to take deposit of these shares.
I mean, it's the elephant in the room. I mean,
It's-
I used to have
it's
400
FINRA.
brokers
It's
that
FINRA.
worked for
Right.
me,
This is a
and there's not one of them today that can buy my stock,
Zero
take my
nine
stock
zero
and
five.
deposit.
This can be
Not
addressed.
one.
So this is a FINRA rule, and it's something that's on all of our so
Right.
we have a legislative agenda, we have a team of people in DC that, you know, we tick off, there's a ton of issues,
Yeah.
right? And if you think about what Pink Sheets was in 2000 to where we are now, it's leaps and bounds, right? There's been
I
a lot.
remember pink sheets in the 80s, so I
Right.
mean,
So
yeah.
what have we done? We've gone
were actually
electronic.
paper.
We've gotten established public market status for QB and QX. We've gotten rule changes around 211. It's a long process of getting to a
In-
marketplace that's better than it was. This is now, certainly 0905 is on our legislative agenda. We've countered that a little bit. We now have, our market data team has what we'll call our compliance file, which we now go to the brokerage firms, so Wells Fargo, for instance, where they get a direct feed of our compliance files, and so they know which companies meet which criteria, so they can at least start building that into their trading systems, so it reduces some of the red flags that get triggered. So it's on the small business agenda. Our CEO is down. In fact, NASA had a conference on Monday. We were there to talk about issues related to blue sky. So there is it's I won't say painful, but it's definitely, you know, we understand the pain around it. It's our market, right?
Well,
So we
yeah, it's your
definitely
market,
understand that
and
pain
the
around
more
it.
participants you have in your market paying your
Right.
fees, the better off your business will be, and your legal business will be. But the main point I'm trying to make, I guess, is that there's a lot of focus on, I mean, I went through the presentations, and everything's about regulations. There's never anything about deregulation.
But that's what this is.
This is
This is
deregulation.
deregulation.
This is dereg-
This is
400
saying
extra
you can go
pages.
public with less disclosure, less reporting than a normal company.
I
if you
think
want.
this is the SEC pendulum swinging
just-
back
I just-
the other way to say, let's make it easier for companies to raise capital.
But
for
my
them to be publicly
basic
traded.
economic training tells me that when the price of capital is skewed towards the bigger companies, then the formation of capital at the lower levels is either going to go down or approach zero. And it's difficult. You know, I don't care what kind of a story you have or what kind of a business you're trying to build. If my first $200,000 every year goes towards regulatory compliance, there's something needs to be streamlined.
Yeah,
And
so that brings up
God
a-
bless my transfer agent who doesn't charge me for her legal advice.
Yeah, so so brings up a really good point. And that's the cost of capital. So let's talk about cost really quick. If we can maybe just give estimates in terms of what would a traditional S1 reporting cost a company of any size?
To go public, you mean? I mean, well, any size. I mean, obviously, the bigger it is, the more it tends to cost. If there's an underwriter, it tends to cost more.
So let's look at 50.
So a typical small-ish S1 IPO, we would probably be charging just legal $250, $300, maybe $350. In Reg A deals, I'm quoting $200. So everything's a little bit less. Everything's a little bit less. That's the idea.
This is great for companies that just want to become public companies now, but for the companies, thousands of companies that are already public, this isn't helping them,
Correct.
Correct.
right?
Right.
Although I will tell you that I actually talked to a company that's a reporting company, and I said, you know, you could just file to become non-reporting, go back and do a Reg A, and come back again.
Yeah.
They could do that. Yep.
Yeah.
Yeah, you can do a Form 25.
if you see a benefit to Reg A versus an S1. Sorry.
Seems like a bear trap when you're finding exemptions for registration as opposed to being properly registered.
Again, you look, we always sit with companies and say, here are the different ways to go public. Every company is different, and you may say an S1 makes more sense for this company, Reg A for this company, reverse merger for this company, not be public for this company.
Don't get me wrong, I applaud your efforts in finding ways of getting capital into companies, but what's the SEC thinking? If they're going to allow something to go through that's a non-registration and exemption, make it something that's promoted by the industry?
Because the idea is that when you're done, you're either going to be a full SEC reporting company or a light reporting SEC company where investors will have a good amount of information versus, no offense, a pink sheet company that gives no information. That's what they're trying to encourage, people to come out of the shadows and bring more transparency, even if it's not as full as a full SEC reporting company.
No offense taken. That's why we created QB and QX.
Right.
I have a question. We know that the SEC is continuing to expand its regulation, or its unregulation, if you will. What's coming next after Reg A++, and with particular emphasis on managing the venues and the new venues that will come up for nano cap and micro cap?
Well, one thing to watch is the SEC Advisory Committee on Small and Emerging Companies, which just had meetings last week.
Last week.
And they approved a couple of things, and typically the SEC pretty much tees up the things they approve as things that they think are kind of okay, even though they don't say it officially. And the main thing they just approved, and we've been waiting at least 10 years for this, is a recommendation that private placement finders who are intermediaries who just make introductions and step away will no longer have to be registered, should no longer have to be registered as broker-dealers. And that's a major plus for some of these companies. And then they also passed some recommendations about in-state crowdfunding and how the SEC could change its rules a little to make in-state crowdfunding a little more attractive.
And the tick size pilot is
Tick size pilot is
something
going.
that's ongoing, and then they are looking at, venture markets is something that's kind of starting to get
That's
on their
Gallagher,
agenda.
yeah.
So what is the right model or market for venture market? Now, we would contend we have a venture market. We actually call it America's venture market. And getting back to that market infrastructure is having everything run through a national exchange advantageous to small companies versus allowing ATSs to handle that and to create better regulation around the ATSs. ATSs always tend to be a little more entrepreneurial, an automated trading system, which is what OTC markets is. A little more entrepreneurial, a little less rigid in terms of standards and qualifications, and a little more creative in helping companies to trade better. So that is something that's on the agenda now and that we're very much involved with.
And also, as Dave Donahoe kind of alluded to earlier, we are trying to get the SEC's attention on expanding the availability of short form S3 for sub $75 million companies, which could dramatically change the capital formation landscape for these smaller companies.
How about trading, though? Trading, though, on with the intrastate impacts that too, because the states now have their own rules
For crowdfunding,
For
yeah.
crowdfunding. So, can you relate to that, please, for me?
About half the states have either done it or are about to do it. They are
Georgia
doing
being
it.
one, number 2.
Sorry?
Georgia was number 2.
Were they? Okay. And they're doing it a little smarter than Congress did in many cases, putting a larger amount that can be raised and so on. But there are so many restrictions on how you do it that it has to be a company located in the state. It has to be only investors in the state. You can't even send a document out of state. And one of the things the advisory committee is recommending is that the SEC relax the rules so that you don't have to be a company located in that state. You just have to conduct the offering entirely within that state. Even if you send it outside the state, you should be able to invest as long as you invest when you're in the state. It's kind of silly technicalities, but they're things that stand in the way of these becoming more successful.
Okay.
We're getting the pull, right?
We are getting the pull. We'll be around, obviously, afterwards, so if you have any follow-up questions, feel free to reach out to any of us here. So thank you so much for your attention.
Thank you.
Thank you.
Thank you, guys.